Welcome to the Rapid Recap. I'm Sasha Evdokov, and thank you for joining me today. Hope everyone's doing well this week, and just making the most out of the week with whatever you're doing. Whether that's planning your vacations here for the summer, whether that's doing some work and working hard, or putting in some study time. So I really appreciate you joining me today. And, I appreciate you giving me your time and energy. So this recap, I'm going to just kind of go with the flow of some of the notes that I have. I'm not going to stress about the length. So we'll see how we go and the things that we cover. But I do want to talk about the 80-20 rule and also about buying food and how this really pertains to stock trading. So I always try and do recaps that I can contribute to in a lesson format, some sort of skill, some sort of educational concept that you can take further, maybe not only in trading, but also in life, whether that's running your own business, applying it to a job, or just your personal life. So today we're going to be talking about the 80-20 concept. We'll also be talking about buying food. But before we get into that, I do want to mention that the website did get redone for Rise to Learn, and for those of you that have courses, you do have a new layout, new version, and some of the bonus videos also are on there. So once you go on the website, just everything got updated for mobile versions, responsive versions. Everything just looks a lot different now, and I think you should be happy with the changes. We also added FAQs for every course, different FAQs for each course, and those are also in there, so you can click them and look specifically at the questions for that course. Let's see, we also have a course path. I'll be adding to these different sections, such as recommended path for could be day traders and so forth in the future. So we'll be adding to this a little bit later. And let's see what else. If you would do me a favor, if you've purchased a course in the past, I would truly appreciate a testimonial. We'll be adding testimonials to this here shortly. I've been collecting them slowly, but if you would, just go ahead, send me an email over here, and send a little note. It doesn't have to be long. If you want to attach a picture, we can add your picture or your website, whatever it is, and we'll put that maybe in the reviews section. Whether you've just watched YouTube videos and I've helped and contributed to you in any way, then I would really appreciate that. It would be a great favor, not only for me, but also to other people possibly browsing the website. So in either case, I've also been doing some planning for the books. We've been finalizing some of the books. I'm pretty much done with the shorting book, just going to have to review it. And then it will be published. So if you want to look at all the projects, it's under TRADERSFLY, and these are just some of the things I'm working on. So we'll do the charts for shorting, and that book will be coming out soon. We'll be calling it 245 Money-Making Strategies for Shorting, rather than the first one, Swing Trading. And in addition, I've been finalizing and we finished planning the Options Mastery course. So I'm pretty happy that finished the planning process for that. And if you think the technical analysis course was large, the options course is supposed to be massive. I don't even know how long it's going to be, but it's going to be quite big. I would expect about 20 hours worth of training in that. So I finished planning all that. Need to update the progress bar, but hoping to get that out by the end of the year. It's going to be probably the last course for this year because it's just so big, and that's the one I'll be working on. So with that in mind, let's get into some of the concept. So today we'll be talking about the 80-20 and the buying food concept. Now, I'll start with a simple example of just purchasing food at the supermarket, and we'll just pop up here a little blank page and do some drawing. So in general, when you're going to the grocery store, let's just say the overall grocery store is this big. Now, in theory, we purchase products from all different places throughout the grocery store. Now, me personally, I like to oftentimes eat as healthy as possible. And the more healthy that I can eat, the better I feel, the more energy I have, and just everything else just flows a lot better day to day if I tend to eat well. So typically, if you look at the grocery store as a whole, I tend to think that if you look at this as 100% totality, take a look at the best 20% of the things that you can eat. And the best 20%, roughing the estimate, would be everything that's in this region or area. So let's say if this was the best 20% that you could eat, then you should normally stick to purchasing the majority of your food in that region. And for me, I like to stay in the greens section. So from the salads to the fruits to the veggies. So we typically have to purchase produce frequently because we buy fresh things. If you buy more frozen things, they tend to stay good a lot longer. So for us, we always look at the top food quality that we can, the freshest things, the healthiest things. And if you stick to that, then you're picking the best of the best. Now, you can take the same concept and principle to stock trading. So if here is all the stocks in the stock market, and you have all the stocks right here, and between all these stocks, there's, let's say 5,000-6,000 different stocks that you could easily choose at any given time. But what you want to do is stick to, that top 20% and just constantly look at those, the ones that you're comfortable with. Now, the top 20% for you may not be the same as for me. That's the main difference when it comes to stock trading. So whereas with groceries, we kind of, the body acts the same way, but for some people that are diabetic, they need to stay away from certain types of foods and so forth. So in stock trading, it's going to be a little different. It's going to depend on your goals, your style, your risk tolerance. There's a lot of different factors. But again, you stick to the top 20% of the trades that work for you. In fact, there is usually no reason or point to even bother looking at those except from time to time. There's almost no point. Now, I do scan them from time to time to catch certain breaks, to just take a look at certain other stocks that could be building cause and effect that are great setups. But you can look at this as a whole to the stocks that you're focusing on. Okay, so the top 20% are the ones that you're focusing on right there. Now, you can take this concept and also talk about it in terms of patterns. So sticking to the same familiar patterns also would be the top 20% right there. So if you're not used to trading the gaps and trading those kinds of style of trades, then there's no need for you to be trading stocks in this region and area. If you're not used to the gap and it's not in your top 20%, then you need to stay away from it and not trade that theory or that concept or those types of trades. Now, as we dig deeper, now this is usually the surface level of how most instructors and many teachers talk about the top 20% and so forth, the 80-20 rule and principle. For me, I always look at things a little bit different, and I like to take things a little bit deeper. So if we do our drawing again right here, and we take I'm going to make the top 20% a little bigger. We take our top 20% right here. So this now is our top 20%. Let me redraw that. Had a little issue here. So here, top 20% right here. So let's say that's our top 20%. Now, this is where most people stop, is they look at this top 20%. what I want you to do is continuously zoom into the top 20%. Now, this 20% actually becomes your 100%. So before, this was your 100%. Now we have 20% of that. This is now your 100%. So now what I want you to do is zoom in a little further and do 20% of that. So really, as you start doing the multiplication and start getting less and less, since this is the 20% right here of the 100, now we're getting into this cube. Okay, so as we get into this cube, this now puts us at a even smaller percent bracket. This is in fact 4%. So we're constantly downsizing our 20%. And we go again with the same thing. You're always looking to make things smaller. So now we take that 20% and maybe we go here. So after you do this 2 or 3 times, you're going to be left with this small little square. So let's just make it a little bit of red. So you'll notice that if we do this 20% multiple times, you're really just focusing on the best of breed. Okay, so trading the leaders for you. Now, for me, the leaders are typically the most common leaders, and that is because I like stocks that move. I like stocks that behave in a certain way. I like the liquidity, and it's just my trading style because they move. I want the fastest moving stocks in the shortest amount of time, but you know, some of those stocks are a little more expensive and they may not fit with your trading plan. And that's perfectly okay. So for you, if this is the penny stocks, that's fine. There's nothing wrong with that. But you want to trade the top 20% that are your most successful or most probable trades. So as we zoom in, then you're going to trade the top 4%. And as we continue to zoom in, again, you're going to be trading even a smaller amount of that. So you constantly keep zooming in more and more from the initial 100 to a smaller and smaller amount. And that's your end goal. Whether that goes along with shopping, whether that goes along with anything that you really do, you're always trying to zoom in finer and finer details to really just do the best thing that you can, the most efficient thing to have the highest probability of success. Okay, now typically as you progress, the behavior is going to be consistently repetitive over and over again. You'll start doing the same type of trades, but they'll have a higher probability outcome for you. But that is exactly what you want. You want consistent trades, trades that look familiar, trades that look the same, so that way you have a higher probability of success. Typically, stocks behave the same time and time again, especially if you're trading the same stocks. And this is really just due to human behavioral. The way that we act, the way that we behave is just our human nature and human behavioral traits. So if you take a look at just any regular person that, for example, goes shopping, typically we eat the same types of food. So if you're used to purchasing your food at one place, let's just say McDonald's, then you probably will do that time and time again, whether that's once a week, twice a week, 3 times a week, whatever it is. For other people that like to eat eggs every morning, then they'll typically eat eggs every single morning. People that like to eat cereal every morning, they will typically repeat and, eat the cereal every single morning. Now, the same thing happens with stocks. A lot of people out there and traders are comfortable with certain types of stocks. They get comfortable with them, and this kind of makes them trade the same types of stocks time and time again. So as we get comfortable with the stocks, we do the same behavioral patterns. And this is why ABCD patterns, support and resistance lines, all these things really play a huge role. And because of that, the patterns are easily recognizable. Now, it takes time to learn to recognize these patterns, but they are recognizable because of human behavior. They're recognizable because human behavior is very difficult to change. It's kind of like those people that are always worried that, hey, I'm not driving. I'm not a bad driver. Everybody else is just horrible drivers, but it's not me. It's definitely not me. I speed fast because I'm a great driver. Because we always think that we're better than we are, but that's just our thinking of being more naive than really where we should be. We're less humble about the situation and we're less aware because we don't want to say that, hey, I'm just not a good driver. Just the reaction time that I have could be really bad, especially if somebody jumps out in front of my car. So just be mindful of these things because most people are not. Most people are not mindful or not aware, or they just don't want to be honest with themselves saying, hey, I don't understand this concept. And especially if there's things that you don't know. So if you don't know certain things, you don't know the things that you don't know. And if nobody brings it to your attention, then it's hard to even gauge or relate to those things and concepts. So with that in mind, you gotta always look at the bigger picture if possible. If not, you need some guidance. And sometimes you just have to be honest with yourself and say, what if I don't know as much as I think I know? And for me personally, I like doing this from time to time and just starting from scratch. And whether that's flipping charts upside down, which I can't really do on video, and looking at things a different way. But if you take a chart and flip it upside down, you start recognizing patterns in a whole different way. You start looking at charts a little bit differently because you may spot different kinds of trends. For some people that didn't really even know about technical analysis, that trade strictly on fundamental analysis. Again, once you're aware of technical analysis, then maybe it becomes a more of an eye-opener. So in either case, in wrap-up or in summary for this lesson in this video, I do want to mention that always focus on the best of the breed stocks and just be aware that the situations and things and concepts that you might be seeing, be mindful and humble that you may not know what you don't know, and you may not be aware of certain things. So don't think that you're better than you are. And this just helps keep your mind open to new possibilities. This helps keep your mind open to learning new concepts. And so getting into the stocks, let's look at some of the stocks along with the application of what we just discussed. So some of the stocks that I always discuss, for example, like the Amazons, the Facebooks, we talk about CMG, we talk about the popular companies. So I normally talk about a lot of these popular companies because I trade them time and time again. And when you trade things time and time again, these are my 20% or my 4%. It just keeps zooming into my best of breeds or highest probability of success trades. So looking at these stocks, let's look at some of the stocks that move, the way they behave. It's all about that cause and effect energy. Just like people with their behavior do similar repeatable things, same thing with stocks. They behave. They breathe a certain way. And once you start learning how they breathe, how they act, if you think of them as a person, it'll start changing your mindset. It'll start opening you up to a whole different concept. So looking at Apple here, let's just take a look at the chart and see how it looks. So here, looking at the Apple stock, we talked about this one last week. As the stock powered higher, I didn't trade this one the previous week, but the trade worked out great. We were just allocated in different companies like CMG and IBM and so forth. And Yahoo, shorting Yahoo and so forth. So here, looking at Apple, we had earnings come out, the stock popped, and then it rejected the prices on volume. So if you got into this trade right there and did a short for 5 points here, it would have been a great win. So out of 1,000 shares, and I know for some people 1,000 shares would be a lot to short, but you could have made $5,000 in just 8 days. So the trade would have been great because here was the supporting higher resistance line right there at that swing point right there, and the stock rejected it. The energy, think about it. Energy pushed it higher, but it didn't have enough energy. Energy then sold it off. So what's going to happen? It'll continue to sell off further. That's just natural behavior. If you can't push a weight higher, if you have weightlifting and you're pushing a weight, you got it. You got that little jolt. You're pushing it higher, but you just don't have the energy. You've been working out. Let's just say you've been working out right here for the last 2 months every single day. You get into that gym on this day and you try to push yourself. You're not ready. You haven't put enough time and effort and energy into working out. So maybe you need a few more months to really build up that energy. It's just all about the energy, just like human behavior, just like anything with energy. This is what happens. It tries to push it higher, rejects it. Could have shorted it right there, nice volume, and stock continued to sell off further. If you wanted to look at this trend line, you could have done this as well and waited for different things. Now, where this stock comes back to, we don't know, obviously, but swing lows right here would be nice. But the stock is a healthy stock. There's nothing wrong with the stock because if you look at the weekly trend, it's just really consolidating. But relatively speaking, on the more inter-day trade, you can see that right there was the rejection point. Now, if we take a look at, let's just say Facebook, also a very similar point and concept. Here was our swing points right here. Talked about this in the critical charts. The break was here. The initial sign actually was this bar right there because that bar was also a rejection. Let's make that smaller. If we go right here, you can see it rejected those price bars right there, sold off, and another entry to the short side was right there, giving you a nice run to this swing point. So that as well gave you a nice $3 run to the short side, just because it was weak. The energy was there to the downside. The market is at its highs. The stock was at its highs. So what do you think is going to happen if it can't push it higher? It's going to push it lower. So that's another thing that happened. If you like trading the gap-related stocks, Amazon, we played this one, and here was let's just zoom in. Here was the lows on that huge pop, and typically stocks that gap up really high very quickly tend to fill the gap or at least sell off quite a bit. So if you would have waited for that to break, even if you are in it now, it's still an 8-point gain to the short side. So typically these gaps fill, but it doesn't mean there's anything wrong with the stock. When you're shorting a stock, it's a temporary position because stocks that go down, they usually go down just for a small time frame. I don't like to use the word short time frame because people may get confused. So typically stocks that move lower and you want to short, on stocks that are like this, that are powerhouse stocks, they are shortable for a smaller time frame because there's energy to the upside. If you're shorting them, it's a temporary move. Now, on the flip side, you can do same thing with like stamps.com. Here it is. Again, this one took a little bit of time and energy to build, and there was your lows right there. And once it started to break, coming down right here, $2.70 gain right there to fill that gap. We talked about Urban last week, did the same exact thing. Look, gapped up. This was a small gap. You got to look at the size of the gap. Size of the gap does matter. So here also, boom, stock broke right here. Took a little bit of time to build. But, even if you like trading these $40 stocks, which is fine, there's nothing wrong with that. $1.42 for a gap fill. 1,000 shares, make $1,420. So there's nothing wrong with these trades. They're good setups and clean setups if you like those kind of clean setups. Let's take a look at waste management as well. Okay, good trading for the short side. Right here's the upward support trend line. We talked about this one. Broke here. Get out of this position here was earnings. And then again, you could enter short again for another few points. So really on that trade, rather than making $5, you probably would have made only $3 because definitely don't trade during earnings. Remember what happened with Twitter the previous week with the earnings here, or Buffalo Wild Wings. Same thing. The stocks can sell off very quickly for 13%, and you kind of get stopped out for what is this, multiple months, 5-6 months of gains wiped out in a single day. But when stocks pull back, this is what people don't understand, is when stocks are pulling back, like we'll talk about CSX here, the stock broke higher, and oftentimes when stocks pull back just a little bit, or more or less JetBlue, actually, people don't realize and understand that when a stock pulls back right here for just a couple days, that doesn't mean there's anything wrong with the stock. That's just normal, healthy profit taking. But if you had 1,000 shares, which would have cost you $21,000, but if you had 1,000 shares, $1 gain on a $20 stock is pretty good. So you would have made right there $1,000 on 1,000 shares. So, there's definitely potential and opportunities, but $1,000 on $20,000 investment, that's pretty good in just a couple of days right there. So 9 days. So, you got to look at the bigger picture, that, look at where's the energy going and how the stock is moving and reacting. So as far as CSX, we're out of this position only because we saw this heavier volume coming in and second day follow through. So I didn't want to risk it. Raised my stop obviously after these breaks and got out of that position. Same thing with Yahoo. We're out of that position only because Alibaba is highly controlled. Yahoo's highly controlled by Alibaba, and with earnings on Alibaba, you definitely wanted to get out of the position of Yahoo. You can see how that stock reacted right there, but again, it's hitting the rejection of this internal trend line, so you always want to be mindful of what you're trading. As far as IBM goes, again, you have a day or two pullback, and you got to look at the bigger picture. Where's your stop? Where did you get in? And continue to raise your stop. And if it hits your stop, you're out. Some of the other stocks, CMG, still have this one short, but again, sold most of the position. And now you're just letting things run, peeling some off into strength, and as the stock retraces, you're taking money off the table, moving your stops to go with it, and reducing your overall risk. So simple concept, and as it starts approaching this level, the 610 level, you want to get more and more out of the position. The same thing here, you're watching the swing lows here at the 635 level as well. So there's different price levels you should always be watching. Yum Brands acting fairly well. So take a look at the swing point breaking higher. Here's the daily. You can see right there, a clean break. If you got in it right here on this day, allowed it to run, you're up $6 in 7 days. How many people would love $6 in just a few days? Let's see, what else? MasterCard, I talked about this one. We got in this one the previous week. It was pushing higher the way that I was acting with heavier volume, but it rejected it. So got out of the position real quick, and now we're waiting for the next segment to build. It just needs a little more time. And sometimes things happen that way, is that you get stopped out. So you're waiting for the highs here at $93 or potentially on the safer side, $93.62. to get into a long position. But the stock is building. It's building cause for higher prices if it can make it past that line. So, those are some of the stocks, that I'm watching. GCMR as well, breaking lower. Here's the support line. Again, this was earnings. But watch how things were behaving. We were watching this line, and it was breaking heavier on volume with the earnings. And if it bounces here, chances are it'll continue to sell off further. And Activision as well. First day movement here. Here was the swing high, rejection. And now it built enough energy, pushing it to the upside. Looking at the weekly, there it is at the daily. And if you zoom in on the intraday, you can see that right here, 24 was the break. First day pop right there, 20 cents. Not a huge gain right now, but volume picking up. A lot of things moving well. If tomorrow's a follow-through day, could definitely get some nice higher prices out of this stock. So there you go. That's what I have for today. Just remember, people typically trade the same stocks over and over again. Focus on the top 20% that work for you, the top trades, and then continue to zoom that into the top 20% of that 20%, meaning the 4%. So you constantly keep zooming in. And just watch for your behavior. Make sure that you're not overly confident on your trades. Just stick to the things that constantly work for you, because these charts, these patterns, they're very consistent with one another. They repeat time and time again because human behavior is more or less predictable. It's easy to see how people behave when something happens. For example, if someone is choking, typically people around them will behave and try and, do the Heimlich maneuver and so forth and get them to breathe better and get the item stuck in their throat out of there. If somebody trips and falls, you want to help them and, give them a hand to get them up. If it's a little kid who trips another little kid, they may laugh at each other. So, as we start getting into specific different things and contexts, these things start to get a little wishy-washy. And that's what happens with stocks, is we get a little more confused based on the stock. And it's kind of like kids versus adults. They look at things a little bit different. So the same thing. You have to start looking at the bigger pictures. You have to see where are more people positioned. And that's what the charts really tell you. Does it look at it and see, is it more day traders that are positioned in the stock? Does it appear to be more long-term positions? Because if the stock has very clean charts, charts that are set up similar to this chart right here, similar to the right setup, or what do we have? JetBlue. Again, if the setup is there, then, people are positioned for more of the long term. And some of the other stocks, people are saying, hey, well, I lost a lot of money here. I got into the stock right here. And, I was day trading it and I got in right here. And then, the stock went down 44 cents and I lost. So day trading is risky. Well, you didn't look at the bigger picture. You got to look at the bigger picture. The bigger picture here was for the long term, for the long position. And if you simply just sit on your hands and duct taped yourself to your chair and allowed things to move to the upside, you didn't even have to do much. You just got into the position and just sit, just relax, and allowed it to run with the right stocks. Trading becomes more loose, and people wonder, how am I able to write books or, get things done? And that's because I'm more relaxed. You calm down. You have to just be more calm. Get in the right positions and you sit. You let them run. Similar to how we did CMG. You short it right here, allow it to run. Yahoo, we talked about. If you missed it, look at the previous recaps. So again, we got into Yahoo right here. Allowed it to run for 7 days a week, and it worked out. Normally I like longer runs than this, but the market right now, it's at its high, so we have a lot of weird inconsistencies. And with Alibaba coming out with earnings, you have to be a little careful on that one. Even what is it? IBM, same thing. Right here, multiple days gains, 11 days, 7-point run. You got CSX, the same thing right here, multiple day gone. On the run, $2 gain. That's fine. If you're trading 10,000 shares, it's a healthy profit. And, but it takes time to get there. It takes time to be patient. It takes time to see the bigger picture. And most people are trading and trying to trade on the day-to-day basis, and they don't look at the bigger picture. They don't see these things because they look at the short-term view. And it happens a lot in life. It happens a lot in just day-to-day, the way people run their businesses, the way that people react to just things coming into their life rather than being proactive and knowing that when you know that things become a lot more simple. And that's why for me it's more of an internal joke to where people say, oh well, you got into this stock and you lost a little bit or on this one, or you lost money, and and then 3 days later you notice that the stock continues moving in my favor. And that's because I know the bigger picture. I have a plan. I have an end game. And most people that trade, they don't have a plan. So have a plan. Find the trades that work the best for you, the top 20%. Zoom in to the 4% and keep zooming in. It's like buying the healthiest food that you can. Stick to the top 20% in the grocery store. Stick to those things that work. If you're buying a car, you don't have to have the most expensive car. Stick to the one that works. Most reliable. Everybody's got different things that they focus on. If you want the social status, fine. That's totally up to you. But, then really, if you want to stand out, then, make your car pink. Again, it's totally up to you. But if that's what you want, then to stand out, you don't need to spend a lot of money. You just have to stand out away from the other 80% of the people that have gray, white kind of cars. And, that's what you, if that's what you want, then do it that way. But stick to the top 20%. Be the outlier and then go into the 4%. Okay. And, I guess that's why some people, paint their cars weird colors and have the big rims and, do all kinds of weird, funky things. For me personally, I just like the common things, but I don't like standing out. And, so when it comes to stocks, the same thing goes. Stick to the things that work. Stick to the things that are repetitive. And it may seem dull over and over again, but they work consistently. If you're a basketball player and you're really good at shooting three-pointers, then shoot them all day long. If you're a hockey player and you're great at shooting slap shots, then you want to shoot those all day long. So stick to your strengths and the trades that work out in your best interest, because you want to trade the highest probability trades. And when you trade the highest probability trades, that's when you start becoming more and more consistent. You start eliminating those trades that are just emotional trades or trades that make you feel good. You stick to the ones that you know, and you'll see your profit margins, you'll see your success rate just turn around dramatically. All right, thanks again for joining me. Enjoy the weekend. Enjoy your family, the time with your family. Spend some time. Things are getting warmer. Summer volume, again, usually lighter on the volume and trading because a lot of people take vacation. So just be mindful that volume typically dips a little bit during these months, but that's not to say that there aren't going to be trading opportunities out there or nice trades out there. You just have to watch for the right setups, enter them at the right time, and allow them to run. All right, enjoy and have a good one.